Okay, guys, welcome to Chapter 3 of the Swing Trade and Options course. Today, we will be discussing risk management, volatility, and choosing the right stocks. If you guys are watching this on the recording and you have any questions, feel free to email me, jeff@warriortrading.com. And as always, as we go through the course here, you guys can ask any questions that come up. Just so you know, risk management happens to be my favorite topic. Not sure why I like it so much. It's probably one of the most boring aspects of trading for most new traders, but it is also, without question, probably the most important and often overlooked. So, risk management is what keeps us around through drawdowns, and it also helps us maintain profitability when learning new strategies, helping us understand what we need to get out of trades and what we can risk without blowing up our accounts. So we'll talk about some of the ways to manage risk and how to develop your own strategy today. So what is risk management? Why does it matter? Risk management is a two-step process where you determine your risk exposure in an investment, and two, you use techniques to mitigate that risk that's in line with your investment objectives. Okay, we use risk management, like I said, to avoid blowing up our portfolios or over leveraging ourselves in trades. This gives us the ability to keep our losses minimized and puts us in a position to capitalize on winning trades. We live to fight another day with good risk management. Some of the easiest ways that we manage risk to our portfolio is by never using more than 10 to 15% of our equity in any single trade. Now, this is going to be harder for new traders or traders with smaller accounts, but it is important to keep in mind as you grow your account, you need to shift your focus to capital preservation and toning down your risk. You can still be profitable. I understand that new traders will need to use more than 10 to 50. If you have a $5, $10, $15,000 account, it's going to be very hard to take trades using 10% of your equity because you're not going to have a lot of skin in the game and you're going to see real small gains at first. And if you're just learning, you're just starting out, and you've moved on from paper trading, that's fine. It's fine to have small wins, and you should have even smaller losses. Over time, little by little becomes a lot, and your equity will grow. And once you get an account that's large enough to day trade and swing trade with, you should really focus on minimizing your portfolio exposure with 10 to 15% per trade. This gives you a few options. One, you can take a lot more trades at one time. Two, if for some reason you get into a trade and you miss management and it goes against you, it gives you flexibility to average down, or if you're in a trade that's heavily trending in your favor and you want to put some more weight into it, you have the room to do so because you're not over leveraged in any one position. You can borrow from the rest of your equity. Generally, we want to avoid using margin when we can. Margin calls will ruin us in a flash crash. I don't know if you guys have ever been around for a flash crash or had a margin call, but if you have a small account, it's almost impossible to avoid trading on margin. That's understandable. But when you get to a point where you have a larger account, maybe six figures, you really shouldn't be trading on margin at that point because you're putting way too much skin in the game. And should something happen overnight, a terrorist attack or some horrible economic news, and the market drops, it's 10, 15% or whatever, your positions are going to be liquidated, and you could end up owing, your broker and not getting anything back out of your account. So, very important to consider how much margin you're willing to risk if something is going to happen. Now, if you have a $5,000 account, they probably give you $10,000 in margin overnight. So it's a lot easier to recover from a margin call where you owe $5,000 to the broker than it is where you owe $50,000 to a broker. Okay, defining and setting stop losses and profit targets. This helps you to avoid the deer in the headlight. Any trade that you take, you need to have a plan for it. If you're ever entering a position or a trade and you're not sure why, you're not sure what your target is, you're not sure what your maximum risk or loss on the trade is, don't enter the trade until you can answer those basic questions. When you go into a trade, you need to have a plan. It's like anything else in life. We don't just do it on the fly. And when it comes to protecting our capital, it's something we definitely should be interested in making the extra effort for. So if we're entering a trade, make sure you know where your stop loss is going to be, set it, um, and stick to it. I understand that there are times during periods of heavy market volatility, certain times of the day, when it can be a lot more wishy-washy with the price action of stocks that we're in, especially some of the lighter volume stocks. And so it can be harder to manage your stops. But overall, have an exit spot in mind and be prepared to pull the trigger on it if you don't use live stops. And conversely, have a profit target in mind. I sat around all day today in a couple of trades, and as soon as I entered them, I put out sell orders instantly. This gives me the confidence to know that if it hits my target, I will fill the portion that I'm looking to sell, and I also have my stop losses in place so that if I look away for 2 seconds, something happens, something goes wrong, I'm protected on both sides of the trade. Another important thing that I have learned and I struggled with and occasionally still do struggle with is micromanaging my trades. Um, it is a difficult habit to break, especially when your job consists of sitting at a computer desk looking at trades all day. So for me, it's very difficult to not do this. You have to walk away from your trade once you set it. This applies to swing trading, obviously. Walk away from your trade when you set it. You trust the chart, trust the trend. You know why you're in the trade. You know what you're looking for. You have your orders in place. Cutting your losses when they mount up is key, and letting your winners run and not getting yourself out of a trade too soon is important as well. If you sit around all day and you watch, any chart goes up and down, up and down, up and down, and maybe sideways for the whole day, you're going to watch your P&L go up and down, up and down, up and down, and it's going to psychologically force you into a box where you're more focused on the minutia, you're more focused on the smaller moves, and it's easier to lose sight of your overall target, what you got into the trade for in the first place, that bigger move. The longer you look at a stock come against you after it was just up in your favor, maybe not quite to your profit target, but the rest of the day you just kind of see it trickling down. It's going to play games with your mind, and it's going to make you say, well, shoot, I should have just taken my profits. I should get out of the trade here, and then tomorrow the thing takes off, and you're out of the trade. It causes you to do things you wouldn't ordinarily do when you micromanage. So avoid that when possible. Using options. So I am a big fan of using options to control risk in trades that are heavily in my favor or heavily against me. Now, there's a caveat there. For a trade to go heavily against me, I had to do something wrong. I'm not perfect. I still have losses. I still make mistakes. I still fat finger trades. I still, pull orders too soon or don't put them out soon enough. There was a case where I was in a trade and I set a stop order 10 points below where I actually wanted to stop out, just wasn't paying attention. So when it hit my stop price, which is a support area, the stock fell even harder and my stop order never triggered. And I said, what's going on? And I looked and I set the wrong price. So that's how trades can go against you. We can't control everything 100% of the time despite our best efforts. So when something like that does happen, if you're trading a stock, and we'll go over some examples in a second, if you're trading a stock that trades liquid options, you can use options for a fraction of the price rather than having to average down in a position, and you can control your net average cost through buying puts and selling covered calls like we talked about on Monday. And we'll go over an example in a couple cases where I did that, and it saved my butt without having to expose myself to more than 10 to 15% of equity in that trade. So it allowed me to use a lot less capital to achieve the same result as tying up a larger portion of my account would have. A risk-reward ratio, when we're trading, we want obviously at least a 2-to-1 or 1-to-2 risk to reward. A lot of times we end up with a lot better than that. If we're willing to risk 30 cents on a trade, we want to make 60. If we're willing to risk 50 cents on a trade, we want to make at least $1. Now we can only make what the trade gives us. We can't force it to go $1. So sometimes we end up with 1-to-1, 1/2-to-1, or 1.5-to-1. We don't achieve the 2-to-1 result, but we should strive for that. And when you're searching for trades, when we're going over the strategies tomorrow, we're going to look closely at how to determine how much room a trade breaking out can really have. and that's going to help us understand, um, help us determine our risk-reward ratio. Okay, risk management is something that we all practice every day. We don't cross the street without using risk management. You look both ways to make sure it's clear and that the light is in your favor. These are steps that we take to avoid being a bug on a windshield. So, we know as humans that we have to take risks to get rewards, but that we have to mitigate that risk in order to protect ourselves. So it's no different in our, crossing the street scenario than it is in trading. So you shouldn't take it for granted, and you shouldn't just assume that you're doing everything you can. You should constantly be looking for ways to improve. Okay, so a couple trades that I took this year. One is an example here on YNDX where I used options to control my risk. And the next one is USO. So we got long on this trade very early on in the year after this earnings event back here in late February, early March sometime. And the stock shot up. It's a Russian, it's basically the Russian version of Google. And it caught a huge, huge earnings report. It was a good beat with great guidance, and the stock price was cruising up. Had been selling off for a long period of time, and so I was looking to jump on for a move back over $20. What ended up happening, unbeknownst to me, when we got in this trade, it pulled against us right away and came down. So I started averaging down, thinking the shorts were just hammering this thing, and I thought that it had a lot more upside and we'd get continuation tomorrow. Well, that never happened. I made some efforts here. We never got up on this trade. And over the next 2.5 weeks, you can see that I put in about 14, 17, I don't know however many red candles in a row this is, and sold off 4 points from our entry. Now this was painful because I'd missed my stop area. For whatever reason, I did not stop out of this trade, and I had averaged down. I had a lot of conviction in the trade. I let it get to me emotionally, and so I made some bad decisions in this trade, and it came against us. As it started sliding here, I was looking into the stock, and I couldn't find any reason for the sell-off to be accelerating or to be happening. Well, it wasn't until I learned through just basic market research that Russia as a country had been downgraded, and they were dealing with a ton of debt issues, and all Russian stocks were selling off, and I never made the connection between Yandex and Russia until it was too late. So that was my bad. If I would have just stopped out of the trade and taken my loss, I wouldn't have had to spend the next 2 months trying to trade my way out of it. I was able to, once we broke this area here at $16, I bought some puts to the downside, and I was able to lock in profits every 50 cents on the puts. I had 3,000 shares in this trade, so I bought 30 puts. It's equal to the control of 3,000 shares, right? Because each put contract controls 100 shares. So I had 30 puts. I was able to profit on the move from 16 down to 15.5. I did it again from 15.5 to 15, and then I did it from 15 down to 14. I bought puts 3 times on this trade. So I applied the gains that I made on the puts to the total cost of the trade, and I was able to lower my average down to below $17. But we're trading down here at $13.90, $14, so that's not very helpful. I'm still down 3 points on the trade, and now I have to, it found long-term support right here, and it started trading sideways. So now I have to think of a different way. I could buy calls, but that doesn't really help me if the position doesn't move, doesn't go up. So I sold calls against my position. I sold covered calls because I collect 100% of the premium from selling covered calls. Again, I keep that money, and my gains are capped at whatever the strike price that I sold those calls for was. So I sold calls, out of the money calls, 30 of them, collected the premium, added that to my total cost in the position, lowered my net equity. I did that 2 times up through these moves here, and on this day where the red arrow is, I sold my last set of covered calls, collected the premium. They ended up expiring in May. Excuse me, where are we at here? This is April. They ended up expiring in the end of April, because in May, or at the end of April, we started getting this move to the upside here. We were now with an average of 16, I want to say it was like 1684 or something like that. And I was able to lower my average from $18 to $16.84. We're in a nice uptrending position here. We got over the $16.50 mark, and you can kind of see it just started moving up slowly. I exited this position as soon as I was profitable on it. After holding it down about $9,000 or whatever it was, ended up selling it on one of these moves here to the upside for a point, and I was able to make $3,000 on the trade. Of course, 4 or 5 days later, we get this huge squeeze over this previous area that we were looking for last time. We get this huge move up to $21, and I ended up leaving like $15,000 on the table. But after being down $9,000 for a couple months, I wasn't really too concerned about it. But you can see I never had to buy more shares at any point as this trade came against me. And fortunately, it ended up going and continuing, but we don't know it's going to recover and continue and then break out over $20. We don't know what's going to happen. So we want to get our position or our net cost of the trade as low as possible without having to acquire more shares. Unfortunately, YNDX was liquid enough with options to be able to do that. And I didn't have to take on more equity, risk more equity in case this 1390 area broke. Another trade that this worked on was USO. Now, I went into USO as a position trade, not a swing trade. And starting in December of last year, after oil began selling off, I took my first position with 500 shares at 21.50. And every point that it dropped, I added 500 shares, thinking that, okay, oil's already sold off all last fall, all last winter. We're going to see, some kind of bounce, and I want to be in a position to capitalize on the trade when that happens. So I didn't go full size. I knew I was going to have to scale in until I hit my max size and hopefully flip out. Well, oil kept selling, kept selling, kept selling, kept selling, and we never got a bounce over my average. So here I am chilling with a $19, $20 average, and oil's trading down here. I had 3,000 shares. Oil's trading down here around between $16, $17, $18. So I'm a point down on this trade. So I say, okay, somewhere back in here, I need to make a move so I can profit when it does bounce, because I'm not interested in holding more than $60,000 in this, and I don't know where the bottom's going to be. Nobody really did at the time, and so I bought more puts on the way down here as we kept breaking new lows. I was buying puts with weekly time frames. USO trades very liquid with options, so there's a lot of opportunities to manage your long position using options. And then we started getting moves back to the upside, and I sold covered calls on these days when huge volume came in, usually inventory days, or rig count days, a lot of Fridays where oil put in big moves, and we were able to lower our average to 1734 or something like that, and so I was able to scale out on the move back to 20. So it ended up being a very profitable trade despite holding it all the way down, and I stopped buying right around 18 bucks. 18 and a half bucks. So again, using options to manage our risk in this trade is a good example of how you can survive if you're willing to hold for a long period of time. Now, what's important to know is that when you're taking on a position, you should never go into it with the mindset that I'm going to hold this against me for 2 months or 3 months or whatever. It's not ideal to have to constantly be looking at options chains, checking historical volatility levels, and monitoring these trades 2 or 3 times a week. It's stressful. It's more work than it needs to be, and there's a lot easier ways to make money. So I learned a good lesson on this, thinking that oil would come back, and it put in a small bounce for a little while. It did it again more recently, and once again we're selling off. We're down around $16 again. So it's not the easiest way to make money. It can be done. It's just more work than it needs to be. So keep that in mind when you're looking to take on these trades. You can manage your risk with options if you need to, but it's probably not the best way to go about trading. So for me personally, when I manage risk, I do like to scale into and out of trades that are going in my favor once I'm in control. The reason I do this is because it minimizes my losses to a smaller starter position if I'm wrong about the trade or the market collapses, or it gives me more room to stay in the trade if I have a lot of conviction in it. And I think that it's just caught up in market volatility for a day or two. By taking a half size, it's going to take twice as long to reach my max risk. Now this applies mostly to the mid and large cap stuff. The small cap trades, are kind of a separate strategy that are in its own environment. Small caps behave a lot differently than mid and large caps do. And when we go into that tomorrow, we'll explain why. So generally with small caps, I like to take full size initially because of how the strategy works, and because I know that 70% of the time we'll be profitable on that first day or two after we enter the trade. So I don't necessarily want to scale in because there is a limited time to profit on these trades, and that's why they're so quick, 1, 2, or 3 days usually, versus mid and large caps, which you can get the trend in your favor for a week without really ever testing your stop area. So for mid and large cap, I scale in. I set a max loss for myself in every trade before entering. Generally speaking, I have a max loss of $750 in swing trades. Now, my profit or my equity curve this year is way behind where it was last year. I don't feel pressure. I'm still profitable. I don't feel pressure to take bigger risk to try and make up time because I know the market is cyclical. The market period this time last year was much more stable. I was up $25,000 more than where I'm at right now, but the market conditions were a lot different. So knowing that the market cycles, I can wait around, and towards the end of the year, I expect there probably to be an increase where last year that was my slumping area. Don't know that that's going to happen. I can't guarantee that, but I can't force myself to do things that will conflict with my risk management. So I had a max loss of 500 to 750 last year. This year it's 750, and with this new swing trading strategy, I'm certainly willing to risk a little bit more because it is generally more profitable with the small caps. So I can risk anywhere between 750 and 1,000. Do I always stop right at $1,000? No, maybe I'll stop at 900. Do I always stop? It's not an exact amount because each trade is a little bit different, but those are the general numbers, and I generally don't stray very far from them. And on trades where I have a max loss of 750 in place, I strive to make at least 1,500 on them. Whether we get there or not, it's up to the markets. You can certainly scale into trades to avoid stopping out early. With position sizing, like I said yesterday, I use the ATR on a stock to determine how much size to take initially so that I can put my stop loss outside of the average true range of a stock and not hit my max loss or have that be my max loss. I don't want it to go over. So for example, if we take 1,000 shares with a 75-cent stop on a 1.5 ATR, that's not going to be great for maintaining a 750 max loss. It's going to end up being about twice that if I give the trade the full room that it deserves based on the ATR. But if I take 500 shares on that same stock with a 1.5 ATR, then I can stay within my $750 max loss, because if it drops 1.5 points on us, I'll lose that $750. So that's how I would determine my position size. Now, I've uploaded a position size calculator in the dashboard. It's pretty easy math. If you can't figure it out, or you're trying to do it on the fly and you want to do it quicker, there's a spreadsheet calculator that I have that you can download, and you input the share size, or excuse me, you input your entry price and your stop loss price, and it'll tell you how many shares, and it'll give you the values for each share size, and based on whatever your max loss is, you pick that many shares for that trade. Stop placement. So we talked about this yesterday, we know that half and whole dollar levels hold a lot of stops. They are mental resistance and support levels for most retail traders. It's a psychologically comforting number to see $1 even versus putting a stop at 93 cents. For whatever reason, people still do this, and the algo traders and the institutional traders and the market makers know this. So how many times have you ever set a stop on a trade at 0.99 right into the whole dollar, only to have it come down to 0.97 before it rips and moves back to the upside? You're out of the trade, and what ended up being a winner was a loser or a flat trade for you because of bad stop placement. Market makers, the algo traders, the institutions, they swoop down, they forced you out of the trade, they grabbed your shares so they could profit on the move to the upside. So be smart about where you put your stops, and you have to be flexible with them. More random placement of stops is probably always a better idea. Instead of putting a stop under a $0.50 at 55.49, 55.50, you might be better served with a stop at say 55.44 or 55.40, 3. It doesn't matter as long as it's not close to that area, because if it's going to break the half dollar or the whole dollar and it doesn't get bought back up, it's going to come down no matter what. So it wouldn't matter where your stop was, but there is a percentage of time that it just breaks the area by a penny or two and continues to the upside. So don't get stopped out of a winner because you were too tight on the trade. It's important. Scaling out of trades and taking profits is just as important as scaling into trade, if not more important. When you're scaling out of trades, but when you take a trade, you already know where your profit target is going to be for your first sell position. Now you can sell your full size if you want when you hit your target, but then you're not letting your winners run. You're not giving yourself a chance to stay in a bigger winner. By guaranteeing base hits, you don't give yourself the opportunity for a home run. We don't try for home runs, but when they happen, we want to be in a position to take a ride. So by scaling out of trades with, maybe a half at the first profit target, maybe a half of that half, so it'd be a quarter at the second profit target, and then trail the rest of your size up using low of day as a stop once the trade is trending. That's probably a sound strategy. That's what I use a lot of the time. The small cap strategy, I say that I'm looking to take profits every 5 to 10% on stocks that are under $10. Sometimes I'll take profits at 3 or 4%, and then sometimes I'll wait till 5 or 6%. It's whatever you're comfortable with. But we know for the small cap strategy, we're going to go into a lot of detail tomorrow on it, that when these stocks move, they run for an average of 3 to 5 days, and they put in a move of generally 5 to 15% during that 3 to 5 day window. So we don't necessarily want to take profits, 5 cents up on the trade. We know statistically speaking that they're going to move, likely move that 5 somewhere between 5 and 15%. So we'll look to take profits around that first 5%, and we'll look to take profits at the next 5%, and maybe trail the stop up for the rest of the move, and give ourselves the opportunity for the home run. It's very important that you scale out of trades and give yourself that opportunity for continuation. By not entering and exiting trades with full positions, this applies mostly to mid and large caps, you can maintain a lower net average throughout the trade, and you remain in control of the trade as long as it's moving in your favor. So when trade is moving up through resistance areas, I like to sell before a resistance area if I have a low average and it's within my profit target zone. I like to sell before resistance in case it doesn't get through. If the trade pulls back or whatever, I've already taken profits. I still have a low average, and then when we test that resistance area a second or third time, I might look to add back to it over that number. So if it's a whole dollar number at $100, I might sell at $99.90. Sell half my position. It tests $100 throughout the day and fails, but at the end of the day, maybe it's going to test it again and it breaks out. So I'll put an order in at $100.10, and I'll add back what I sold at 90. So now my average will move up. And I'll be in position for the next resistance area that's going to be tested. Once you take profits on a trade, it's very important that you move your stop for the rest of your position size to at least break even, if not even a little higher, because you have to account for slippage and commission, and there's no reason that once you've paid yourself on a trade to end up taking a loss on it because it came against you. We're looking to scale out 1 or 2 times, and at least once in a trade. 2 or 3 times, probably the total number of sells you'll have in a trade. And if you don't move your stop, you're not going to be thrilled when it comes against you, and you end up losing after your first sell. It sucks breaking even when we don't get continuation, but at least we paid ourselves something for our efforts, and we'll move on to the next trade, and hopefully that's the one that goes and gives us the opportunity to scale out at multiple spots. And again, we use support and resistance levels to identify those add spots and those sell spots. And when we're looking at a bunch of charts tomorrow, we'll see pretty obvious signs of support and resistance. It's not hard to identify them. You just have to make sure you're aware of them before your trade reaches them, so that you're in charge and you're not subject to whatever's going to happen at that area, which is generally going to be more volatile than a stock that's trading inside of a range and not at a resistance or support level. Okay, SLF, we talked about this trade a little bit yesterday. We got into the trade. just as it was testing resistance here, it held the whole dollar, and we added to the trade once it broke resistance with a full size. So now we had a full size with a lower average, and we were able to scale out just before the next resistance area. And I was looking to add back over this $50 area once I scaled. I figured it would be kind of like this. We get a test, and then it breaks out. So here we got a test, and I was hoping for the breakout. So I'd already sold just under this area. Now I'm looking to add back over the top of it for the next move up to $35 here, $34.97 at the 200 moving average. We never got it, obviously, so by trailing our stop up using low of day, we stayed in this trade until back here on the fourth or fifth day of the trade, and we got taken out when a new low was made. We're using the low of day as our stop for the rest of our size. And then this doji here, you can see that the low pierced the low of this candle, so it took us out of the trade, which was fine because this is the one that ended up a couple days later gapping all the way down here. So we gave ourselves the opportunity to stay in the trade and remain profitable. It did not go, so we stopped out with a profit stop on the rest, and that's fine. Move on to the next trade. How to calculate position size to manage risk. It's basic math. Okay, we've talked about that. Do you guys have any questions specifically on how to do it? It is essentially the difference between your entry price and your stop price multiplied by your total number of shares. That's going to give you the dollar amount should you get stopped out at your stop price that you're going to lose. So if you're only willing to risk $500, you need to be able to figure out if I'm taking 1,000 shares with a 50-cent stop, that's my $500 risk. Is that clear? Do you guys want to go over some more examples of that? And again, there's that position size calculator. I get a lot of questions on position sizing. It's very important. It's very simple, but once you figure out, what you need to do to calculate it. Okay, research previous history for events, earnings, news, etc., to evaluate your potential moves. What did the stock do after earnings? So a lot of times stocks will have good earnings, right? And they'll start moving up on volume because their guidance was raised. We're not talking about playing through earnings. We're just talking about it's going to leg up and it's testing a resistance area coming off of good earnings. So there's a good catalyst in play. And now, we want to be a part of this trade as it moves through the next resistance areas and moves back into the next leg up. What happened the last time it had earnings? Maybe it was last quarter or sometime last year where it was kind of a similar result. I like to look back and see, did last earnings this thing shoot up for a couple days and then the shorts come in and pounded at this resistance area, or did it break that resistance area, move to the upside, and continue in an overall bigger uptrend? It's important to know the result of the past events because it can help dictate what happens going forward in the future. And the data is there. All it is a couple of clicks on a keyboard, and you have this information readily available to you. It's up to you to do the due diligence and take responsibility for your trades. So you're putting yourself in the highest probable position for success. You want to be in a position of advantage when trading. So zoom the chart out, use the moving averages. You should be looking back, when you're looking to take a day trade, you should be looking back at least 3-4 months minimum when you're, on a swing trade to get an idea of what the stock has been doing at that price level you're at now. The farther you can go out, year or 2 years, it's probably not going to play as much of a role, as the more recent time frames are. But you should still be aware if there's a massive resistance area you're coming up on, and things like that will save you money in the long run if it takes 2 seconds to do. If you buy into a trending stock, look for violations of previous day lows for an initial stop. If the chart is clean, you can trail your stop using daily lows for a while before you reach a profit target and sell some of your position. So the example of MPC off the bottom the other day, if we, for whatever reason, happened to get in this trade somewhere here, and we didn't know where we were going to sell at, we could have stayed in this trade from about $76 or wherever we got in, $77 here, just by trailing our stop up using the daily lows. And what I mean by that is that there hasn't been a new low made on the daily chart this entire run. This is like a 3-week long run here back up to $100. So you could have bought, your few hundred shares here and put your stop at low of day and adjusted every day to the previous low of day and been in this trade for the entire move to the upside for 30-40 points. This is a very clean example. This is a very clean chart. Same to the downside here. If you were shorting this at this area, you put your stop at high of day, and you could have trailed it all the way down without being biased at this area. You put your stop at high of day, and you could have trailed it all the way down without being violated until right here when we have the reversal move to the upside. So this is a good example. Facebook is probably like the best example of a horrible chart. You can't do this on Facebook. There's just no way because it is not a clean chart. So when you're looking at a trade and evaluating it, well, if let's say I get into this trade, what am I going to do in 2 days? What's my target going to be? Where's my stop going to be? Oh, look, it happens to have a really clean chart where it doesn't tend to violate the lows when it's in a trend. Same with the downtrend, it doesn't violate the highs when it's trending down. So this would be a great opportunity to use a daily low, previous day low for a stop. Not all charts are that clean. Okay, risk management includes several different types of risk that may or may not affect day traders. This is why people don't like taking swing trades. They don't like holding overnight. Obviously, there's people are able to be very successful swing trading or position trading, investing for long periods of time. There's not necessarily any more risk to swing trading if you understand the risk types and you manage your risk appropriately. But a lot of people are put off because of market volatility and other these factors we'll talk about right here. And it kind of scares them away. But if you use good risk management and you have a good strategy, there's really no reason to be afraid of holding overnight. Market risk is probably the biggest influencer of trades, and it's the possibility for investors to experience losses from factors that affect the overall market performance. Market risk is also known as systematic risk. Okay, we saw market risk in play today with the Fed meeting announcement about interest rates. You saw it move the market. If it was bad news for the market would have tanked and it would have sold off. It wouldn't have shot up for the rest of the day. It would have gone down. That is market risk. That would have affected any of our swing trade positions. Operational or business risk is the possibility for investors to experience losses from factors directly related to the industry or company itself. If the CEO gets fired, the SEC investigates, earnings and guidance downgrades, new debts. It's known as unsystematic risk. Saw a good example of this with Lock, Lumber Liquidators. Lumber Liquidators has been affected by multiple types of risk, and most notably probably the legal risk. Legal and legislative risk is the possibility for investors to experience losses from factors associated with politics, FDA approvals, lawsuits, legal actions, and new or unexpected industry regulations that can adversely impact a company. A lot of legislative or legal risk is seen in the biotech sector with FDA approvals. The marijuana, the pot stocks, they were hot last year on, the Colorado and Washington legalizing recreational marijuana. Pot stocks were hot. That's legal risk. If they came out tomorrow and said, oh, sorry, we changed our mind, marijuana is no longer legal in these states, legal risk would cause the pot stocks to collapse. So that's a risk type you're exposed to when you're trading anything. You just never know when something like that is going to come out. Interest rate, credit rate, and liquidity risk are important to know that they exist. Generally speaking, they're not super important. They don't really affect us all that often, except for, and lately, interest rate risk, right? Because we're kind of in this period of flux where we're waiting on interest rates to be raised, and we anticipate a market correction. And if it's not done just right by the Fed, it's going to cause a lot of people to get scared and bail out of equities and put money into bonds because interest rates are going to be going up. So there is a lot of interest rate risk right now. But if you're smart about it, you know when the meetings are and you pay attention to the data that comes out of the Fed, you can manage and trade around that risk. Okay, so risk management as it applies to top-down evaluations of stocks. Okay, I'm a big proponent of top-down evaluations, meaning what's the market doing, what's the sector doing, what's the stock doing. Again, it takes 2 seconds to figure out. What's going on in a sector when all biotechs are moving, or when all the oil stocks are moving, whatever. It takes 2 seconds to figure it out, and you have to understand that it will influence your trades. If the market tanks, there's not too many stocks that are going to shrug off that kind of selling. If you have a buffer on the trade, and you're flexible with your stop, you can avoid getting caught in the market chop. So, the FOMC or the Fed today, if they would have raised rates or said something negative and the market came down, we probably would have seen a sharp decline in all our swing positions and probably just about every stock across the board, except for the ones trading with a strong catalyst, that's independent of the market. Something that is trending heavily for whatever other reasons will probably they might come in a little bit, but if it's not going to be as dramatic as other stocks that are just drifting with the market. Remember, most stocks will trade or drift in the direction of the market, so unless they have a catalyst in play. And if we're in a position, a swing position, and we're up on the trade, we have a buffer that can protect us from that initial market volatility. So depending on the intensity of the news and the likelihood that it's going to impact the markets for the next 6 months, like raising interest rates, you may want to close your positions out and evaluate what's going on. In the event of a false report of bombing overseas or something, the market will probably come in and then it'll shoot right back up, or it'll recover over the next couple days. So depending on the risk, if you have a buffer on the trade, evaluate the risk to your position. Find out what the sector is doing. Here's an example, or these are examples right here of the biotech sector from back in December. IBB is the NASDAQ sector ETF, which tracks most of the large biotech companies. Last December, we saw a sharp move down here, and we saw a gap down and then a huge move to the downside here in the whole sector. We look at what happened to the stocks in the sector, and we can see that in that same time period, ABBV also sold off a little bit, and Guild got hammered the hardest, and it came way down here, and then it bounced right back up and filled the gap like it was no big deal. It was just a hiccup in the road. Well, what happened here? You could pull up any biotech chart from this time period and probably see the same 2-day sell-off that you see in these two individual biotechs, along with what's going on in the sector. What happened here? ABBV released news that was negative for whatever drug it was working on at the time, and it wasn't completely unexpected news. It was just confirmation of bad news. So the stock sold off 3, 4, 5 points here over a couple days. Guild, completely unrelated company to ABBV, they do work on some things together, but completely unrelated, took a huge hit all the way down from 104 to a low of about $86 in that two moves. So it dropped like 20 points, 18 points in that same time period, where the company that actually released the bad news was only putting in a 4 or 5 point sell-off. So some stocks will react irrationally to the news of other stocks, and I think a lot of this has to do with fear of Guild investors that think that, well, if something bad happened to this company who's working on something similar, it's only a matter of time before it happens over here. So there's a sympathetic reaction, and we see a lot of sympathy across sectors. You'll see a lot of that in some examples when we look at the whole Ebola craze. But you'll see a lot of sympathy, and in some cases it's way overstated, which obviously investors felt the same because they bought it back up over the next few days and it recovered. A month later, it was trading right back where it sold off at, whereas ABBV never came back. Beta. I tend to use beta a lot more in day trading reversals than I do in swing trading, but if there's a stock that I'm not familiar with, or a stock that hits my scanner that looks like it might have a good setup, but I'm not sure about its history or why it has such volatile price action, I'll look up its beta. A beta is a measure of volatility that affects our portfolio. Beta measures the volatility or systematic risk of a security in comparison to the market as a whole. That means beta is a ratio, and it's called the beta coefficient. A beta of 1 means that the security will move with the market 1-to-1. A beta of less than 1 means the security is less volatile than the market, and conversely, a beta greater than 1 means that a security is more volatile than the market. So if a stock has a beta of 1.5, in theory, it's 50% more volatile than the market. So why is this important? How do we use this to our advantage? Well, if a stock has a beta of 1.5 or 2 and the market takes a dump, we can expect that the volatility of a stock that has a beta of 2 is going to be 200% more the sell-off is going to be 200% more volatile than it would in the S&P. So basically, beta, it's a measure of volatility, and it helps you understand if there's an event that happens, not necessarily to the stock itself, but a systematic event that affects the market as a whole. How is this stock going to react? Is it going to react volatile? Is it going to shrug it off? There are betas of there are negative betas, believe it or not, and those are stocks that trade inverse to what the market is doing for the most part. There are stocks with a low beta. You can have 0.01, which means that the market can tank and the stock doesn't care. It's just going to do whatever it's doing for the most part. Drew, I see you typing. I'm going to get a drink of water. Right. So beta it's a running calculation. Yeah, because price action and volatility is always going to be changing. So for the most part, you're not going to see a beta. You're not going to see a stock that shows a beta of 1 today and then a 1.5 tomorrow. I'm not exactly sure the time frame in which it's calculated, how far back it looks. I don't know how many events it accounts for, but yeah, it's a number. It could be a 1 today and it could be a 2 next year, or it could be 1.5 in 3 months. It's going to depend on the price action going forward. This is based on historical data, right? So if the stock becomes more volatile going forward because they are doing a bunch of mergers and acquisitions, or they're doing human trials and new drugs, and they've announced, experimentation on other drugs, it can become more volatile. So yeah, it is going to be changing. But when you see it at the time you're looking at it, it should be current for any historical volatility in the market. It does not account for future volatility. Does that make sense? Cool. So trading psychology and trade management. These are a few things you're probably all familiar with. Over trading, we've all been there. We've all done that. Everybody's pumped to make money. We see all these different opportunities hitting scanners. Everything looks good. But in reality, we know that we're not going to be trading with a 100% win ratio. So the more we trade, in fact, it's going to be the opposite. It's not the better we get, it's the worse we're going to get. So our win ratio is going to drop just because we're taking on more trades. That's just how it works. So not only are you risking more losses by trading more, but you're also paying more in commissions and fees, and it can add up quickly. Personally, if I trade 10 times in a day, that's a very, very, very heavy day for me. When I first started, there would be days where I'd take 20, 25 trades. I'd make a couple $100 on it on most of the trades. I'd lose, 100, $150 on some of them. But at the end of the day, maybe I made $600 and I couldn't figure out why. If you went on 20 trades and you're making $200 a trade, why did I only net $600 today? Well, because I'm scaling in and out of trades, paying, whatever it was, $8 or $9 of commission. I had like $1,100 in commission, and it was kind of that day that I realized, oh my God, this is bad. And, it's not making me more money to trade more. And so the focus should be on trading more size on better setups. Okay, avoid speculative plays with the attractive reward profiles. Like I said in USO, calling tops and bottoms is very difficult, and it's a good way to blow up an account. Despite your conviction in a trade, despite how much you like the stock, you think the news is good, it's probably already been priced in, and if it's not going in your favor, you're probably wrong. So you have to get over that emotional hump of, you have to be able to let go of the mental attachment that you have with the trade, and you have to be systematic about it. Know your risk reward profile and stick to it. Every trade you go into, even if it's a day trade scout, and you say, okay, I'm going to give this thing 10 cents here to either go or not go. But on the chart, it might only have room 5 cents before it hits another resistance area. Maybe that's not a good trade because you're trying to make 5 cents before realistically you can expect a slowdown, but you're risking 10. That doesn't make sense. So if you're saying I'm going to risk 10 cents on this trade, I need to make at least 15. I need to make at least 20. And then that's where you start your scaling process. You start selling out there. You need to have the room in the chart. Of course, it's nice to say, well, if I'm going to risk 10, I'm not going to sell till I make 20. And it pops up 19 cents and then comes down and stops you out. That's frustrating. So you have to manage the trade when you're in it, but you shouldn't enter the trade without a risk reward profile that's favorable to you. One thing that I've done and I still do is I cover my profit and loss window. Like I said, I sit here all day. This is my job. My job is to put out trade ideas, look at charts, and make money, make a living off of trading stocks. So it can be a big emotional draw to have to want to look over at your profit and loss window. Did I hit my daily goal? Did I, what can I risk on this trade and not give money back on my daily goal? It it changes the dynamic from which you're trading to, instead of trading the chart and the technical setup, it changes that to you're trading based around a profit and loss window, which has no bearing on the trade itself. So you're not giving your full attention to the trade. You might think that, oh, it's not a big deal. I can look at the profit and loss window and not let it affect my trade. But if you catch yourself trading and looking at your P&L at the same time you're in a trade, then you're obviously not able to give the trade 100% of your focus, whether you're looking at the level 2 or the charts. So cover it up, minimize the window, put it in your desktop, hide it somewhere on your desktop, wherever you're not going to be peeking at it. And then when the trade is over, because you got stopped out at the area you planned to get stopped out at, or you took your profits where you wanted to take them, then go look at your P&L and say, oh, cool, all right, I made this much, I hit my daily goal, I'm done. If you sit here long enough, you can truly convince yourself of anything. And that kind of goes back to the emotional part of us. Unless you're a sociopath, I bet a sociopath would make a really good trader. But as far as the rest of the world who aren't sociopaths, you are going to have emotions that come into play, so you have to control them. If I sit here for too long, I don't have to do this anymore because I have enough to do. The house, I have a dog I got to take out every so often. Get up and walk away from the computer. Set your phone so you don't get tunnel vision and locked in at your desk, convincing yourself of taking all these trades that look great because they're hitting the scanner and this and that. There's nothing worse than giving back money after you've made money. I've said it before and I'll say it again. I would rather take a trade and lose $500 without ever being up $1 than be up $500 and end up losing that on the next trade. There's nothing more infuriating to me that upsets me and puts me into an emotional state that doesn't allow me to trade the way I need to be trading than giving back money. I don't mind taking a loss. I don't mind being wrong, but I cannot handle giving back money. Revenge trading, we've probably all done that, where we just timed the trade wrong, and so we saw it move up right after it stopped us out. So now we jump back in it, try and get our money back, and then we get stopped out again. So now we're pissed off, and now we short the trade, and it bounces and it goes up against us again, and you end up taking 3 or 4 trades in 10 minutes, and you blow up $1,000, whatever. Revenge trading, it's purely emotional. You're not trading the chart, you're not trading the patterns. After the first stab or two, if you're wrong, you're not seeing, for whatever reason, either the stock is not cooperating or you're not seeing the ball well, so to speak, and so move on to something else. Seek higher percentage gains versus dollar gains. This is going to help you to understand and maximize the profits on the trades you're taking. Slowly build up your size to increase your dollar wins over time. When you're looking at taking a trade, it's easy to think, this applies to swing trading, because in day trading you really are just dealing with, okay, I want to make 10 cents here, I'm going to risk 5 cents or whatever. You don't have time to figure the percentages, but when you're swing trading you do. And when you're looking at a couple of different trade opportunities, because you have time to evaluate these things, say to yourself, all right, I have the ability to make 3% on this trade based on the chart, and I have the ability to make 12% on this trade based on the chart. Which one do I want to take a stab at? Even though one might be cheaper, one might have, you might like the stock better for whatever reason. You might prefer trading this one. Look at it objectively and see what's going to give you the highest percentage return. And generally, when you look for higher percentage returns, you're going to end up getting higher dollar gains as well. It gets harder to look for higher percentage returns when you're trading more expensive stocks. $100 stock, I'd love to make 5% on that, because that's a 5-point trade. Realistically, those types of trades, if you're looking for a swing trade, you can still do it the same way. It's all relative, but the higher dollar stuff is probably more looking at the dollars and cents. So for the small cap stuff, that's why I always say we're looking to take profits 5 to 15%, not looking to take profits at 30 to 60 cents. On some trades, it might be 30 to 60. That might work out to 5 to 10%. But I'm looking for percentage return. Oversizing, this happens to me sometimes on a day trade. If I like the stock, I like the setup, and I like the volume, and I like the trade, I'd be like, normally I would risk 10 cents here, but I'll still risk 10 cents, but I'm gonna take twice the size. And if the trade doesn't work out and comes against you, have a loss twice as big as your risk profile permits you to have. You broke your rule, therefore you're now losing more money than you would, if you were following your rules, and you've become less profitable. Oversizing, it can happen easily. You get excited about something, it's not hard to do. So it's just one of those things you have to keep in the back of your mind. Even though you really, 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 really like this setup, and you like the stock, and you like the price range, you have to treat it like it's going to fail. You have to plan for it to fail. And so in doing that, you prevent yourself from oversizing. You let your wins aggregate. You don't try and go heavy on the ones that look the best. Okay, you have to have confidence when entering a trade. This goes back to the why. Know why you're entering, know where you're stopping out at, know where your profit targets are before you ever hit the button to execute the trade. Okay, it's very important we don't trade on hope. If you've ever used the word hope in a trade, you've probably done something wrong. I hope the trade comes back, or I hope it goes up from here. I hope it keeps going. You shouldn't be trading on hope, right? You should be trading with confidence and conviction. Patience. This is a big one for swing traders especially, waiting for quality setups with the right conditions. Common sense, right? We don't just go out and trade everything because it's moving or because it shows up on the scanner. You'll see that I'll alert, some days I'll alert 3 trades, and then I'll go 3 days without alerting a single trade. Wait for the setups to come to you. Don't force the trades. Don't feel like you've missed out. Fortunately, I've been fortunate enough to have been able to do this for 10 years now, and I have seen just about everything, every crazy thing in the market, including how cyclical events are and how cyclical price action is on stocks. In the very beginning, I always felt like, oh, damn, I missed that 2-point move. There's not going to be another, there's 2-point move every single day. There's 20-point moves every single day. There's news events every single day. So if you miss a trade, don't feel like it's never going to happen again. We can sit around on news and wait a week without a good news trade, and then we get one and it makes our entire month, and we just had to wait for it a week. But if we're constantly chasing ideas, we're beating ourselves up about not being in trades and missing good setups. If you find that you're missing out on a lot, then maybe you're hesitating too much. Maybe you don't have the confidence to enter trades. Maybe there's another issue there. But if you're just kind of antsy and trigger happy, wait for the trade to come to you. Wait for the one that gives you the opportunity to get into it. And don't ever feel like you have to chase. And don't ever feel like you missed out, because there will always be another opportunity. And probably most importantly, you need to keep a written trade log of what is working for you and what isn't. Again, in the dashboard for students, there is a downloadable trade log. It's the same one I use. It's the same one I put up on the website. As part of being an active trader, if you want to do this, yes, point move is a full dollar up or a full dollar down, correct. If you want to be an active trader or you want to do this for a living, you need to have some sort of written trade log. Now, yes, your broker keeps track of your trades for you, but that's not what I'm talking about. You need to have something that you can go back to at the end of every month when you're reviewing your trading plan. And you say, did I meet my goal? Did I hit my goal every day this month? No. Did I hit my goal every week this month? Maybe. Did I hit my overall goal for the month? Yes. You never know what's going to happen, but then you need to go back. If you're missing your goals for the week, or you're missing your goal on the month, is your goal set too high, for the size of the trades that you're taking, for the amount you're willing to risk? Maybe you need to adjust your goal. Maybe you took too many reversal trades and you have a 30% win rate on reversal trades, and instead of focusing on the 70% small cap breakout trades that you're more profitable on. At the end of the month, with a trade log, you can go back through and you can look and say, okay, well, I suck at reversal trading, so I'm not going to trade those anymore. I'm going to trade them on paper until I figure out a better way to do it, and I'm going to focus on what's working for me, and I'm going to put more size into those trades. And every month, you should be evaluating this trade log of yours to see where your strengths and where your weaknesses are at. Otherwise, you're not evolving as a trader. Remember, when you want to do this for a living, you're an entrepreneur. You literally eat what you kill, and there is nobody to blame but yourself when you mess up. There's nobody to work for you when you call in sick, and there's nobody that's going to put money in your pocket without you going out and putting in the work to get it. So, as any entrepreneur, I've owned small businesses before, and I can tell you in the entrepreneurial world that some 60 or 70% of all small businesses will fail. We also know that most small businesses that do survive aren't even profitable in their first 3 to 5 years. So they're operating at a loss. The ones that do survive, that grow to become larger businesses, eventually corporations, those are the ones where it's just the owner and maybe one or two other people that put in 80 hours a week. They sacrifice, they don't pay themselves, they don't take money out of their business, they don't make excuses, they just keep grinding and they keep working. Perseverance will eventually pay off. And if you're trading and you find yourself struggling, unless you have unlimited capital, you really should be trading from a paper account, because that is what is going to allow you to protect your capital while you're figuring this out. You really shouldn't be practicing or learning on a live account. I know that greed gets the best of us, and that's why we're all here on a live account. I know that greed gets the best of us, and that's why we're all here on some level. But if we don't do it the right way, we will end up like the 90% of traders who do fail. And it's because most people that come into this industry are doing it to get rich and to make a ton of money, or to have the freedom to work from home and stay with their kids or whatever. There's a million reasons. Everybody has their own. But there's one thing that's certain across the board, and it's that not one person is going to get rich overnight doing this. They're not going to get rich quick, and they're not going to get rich without putting in the effort and tracking their results and building and evolving and adapting as market conditions change and managing their risks. So again, that's why this is my favorite portion of the course. I find it to be the most important, and it's ultimately what's going to help you survive. If you have control over yourself, your emotions, your risk, you maintain discipline and confidence, and you never stop. You never stop learning. You never stop trying new things. You never stop back testing or paper trading. It's very easy to see the light at the end of the tunnel. And once you do, it should trigger inside of you a reaction to only want to work harder. And the harder you work, the more reward you can reap. And so that concludes our risk management portion of the course. If you guys have any questions or comments, now is the time to ask. If you're watching this on the recording, you can email me, jeff@warriortrading.com, and I'll be happy to get back to you with any of your concerns. Awesome, Brian. No problem. One thing I want to say also at the end of this here is that a lot of what I've said today might seem like common sense, and it definitely is on some level. Maybe you learned some new things. It's not until we become self-aware and realize, from a perspective that's not first person. You almost have to realize a third person. You almost have to realize from a third person's perspective how you react in certain situations, because trading, it affects us emotionally, and it affects us, it can affect us physically. It can be stressful. It's not until you're self-aware of how you react in certain situations that you can overcome any of those psychological hurdles that will just lead to more failure. It's very important to maintain discipline and to understand yourself and how you react in those situations. I know people who are super emotional people. They make terrible traders because they get pissed off when they get in a losing trade, and it just leads to revenge trading. I mean, it's not that you can't be emotional, but it's that you have to be in control of your emotions. Otherwise, they will cost you money. The risk formula, one more time. The risk formula for calculating share size, Drew? Sure. So if your entry is, let's say your entry is at $10, and you chose to have, based on what the chart looks like, you chose to have a stop at $9.75, because that's where support is, and if that breaks, you don't want to be in the trade. So your stop loss is 25 cents away from your entry. If you have a maximum a maximum loss per trade of $250, you're not willing to risk more than 250 on any trade. Your goal is to make 250 to 500 on every trade. You can risk 1,000 shares. So you'll take 1,000 shares at $10 with a 975 stop. That's 25 cents or $250. If your max loss is $500 and you have a 25-cent stop, you can take 2,000 shares at 25 cents. Does that make sense? You subtract your stop price from your entry price, and you multiply the number of shares till you get to your max loss. Yeah, so when you're going into a trade with, if you're willing to risk 25 cents on a trade, realistically, you should be looking to make 25 cents on the trade, if not more. That's a minimum of 1-to-1. We really want a 2-to-1 based on the chart. If there's no resistance and it's clear skies for 50 cents, that's ideal. And we're taking profits along the way. We're scaling out if there is resistance along the way. We're taking profits every 4 to 5%. We'll take half, and then we'll take half of that. We'll take half of whatever's left, and we'll put a stop at low of day so that we can stay in the trade as it keeps going. But yeah, if you're risking 25 cents and you start selling at 10 cents, then you're doing something wrong. Because if you would have waited for that trade to go against you and waited till it came down 25 cents on you, why are you selling when it's only up 10 cents in your favor? That's not a good risk to reward ratio. Okay, guys, cool. Thanks for coming. Tomorrow's session will be on the introduction to our swing trading strategies and some classic swing trade patterns. We'll also go over the small cap breakout strategy and the scanner and how I put together those trades that we've taken in the past couple months here that have been super successful for us. Other than that, you guys have a good night. We'll see you tomorrow.